Welcome back to Train with Brian's Uni BootCamp. I laugh because I just went through the whole rant because I would hit the record button rather than hit the stream button. So kind of a funny start. Hey, there we are. We're live on YouTube. So nice to see everybody over there. Hello, La 210. I would imagine people will slowly trickle in here, but anyway, kind of a funny start to the video here today. But did try in earnest to get started on time. And if anything, this is going to be our sort of 4-part mini series on trading with Fibs, chaos theory, and harmonics. So I had to do a little bit of extra lifting there last week. Just sort of introduce a little bit of what Fibs are and the Fibs sequence and, fractal nature of the universe. This week, part 2, which should be a little bit shorter. Hopefully, maybe only like an hour and a half or so. Fingers crossed. But of course, when I say that, it's probably a good couple hours, but we'll see how we do. Anyway, this is part 2 of our lecture mini series here on Fibs, chaos, and harmonics. And we are going to be operating off of the same document. I think I'm going to put all of these pieces together on one document here. So as I said, to start this off, spend a little time right at the beginning talking to you a little bit about the Fibs sequence and why these numbers are so important in our universe, including some outside resources for you to check out on your own. Doodling in Math Class, I think, is a great video lecture series on Fibs, just understanding the basics of it. Spent last week the sort of primary learning objective, if you will, was to introduce you to retracements. That's everything within a range, if you're thinking about pullbacks. Interestingly enough, actually, when I first started in this business, this word retracements wasn't actually in the English language. And when you go on word processing documents, it would always say that it was spelled wrong. So it is kind of funny how I've been doing this for so long that even the word processing documents and spreadsheets and all that kind of stuff now actually recognize this as a word. But included a couple old retracement tutorials that I've done over the years as kind of a juxtaposition of the current lecture. So I think between all 3 lectures, you should have a pretty good idea of what ranging market state Fibs look like, all these Fib retracement levels. And as well as I said, hopefully a nice introductory sort of walkthrough of what these numbers mean. Left you off with some assignments and, of course, level or one-on-oneers. I would like, of course, for you to be now incorporating Fib retracements, which you primarily are, into all of your trade location identification protocols. So this week, part 2 of this series, we are going to get into extensions. And in essence, these are the tools that we're going to use within trending market states to understand extending of trading ranges. So as well, I have included the 2 previous video free lectures that I did on Coinigy years ago for your reference. I don't know how long those videos will last. If anything, maybe my assistant, while we're here, maybe could even hint, maybe please, hint, please, hint, please. go and actually download these videos and maybe upload them to our crinvestorcontact@gmail.com drive, just so we have those videos at least saved, and maybe I'll link them to the drive folder. This is just linking directly to YouTube. And so thank you, sir. So if they do disappear from YouTube, they'll be gone, obviously. So maybe we'll try and save those in our own private folder so you can have links to those indefinitely. But again, same sort of thing as last week. Watch today's lecture, and if you want to dovetail to sort of reinforce all of the concepts that I'm going to talk to you about today, check out the Fibs. And you can see I've been doing these lectures now for literally more than a decade. That's scary. So I think I've gotten pretty used to these concepts, not only trading, but actually teaching people about this stuff for that long. Anyway. So as the name implies, extensions primarily, we're going to be using these in trending market states to try and understand where prices may go to in the future, just based purely off of the math of the matrix. Just as the definition outlines, extension studies created by taking two extreme points, usually obviously a major peak and a trough, and projecting key Fibonacci ratios: 113%, 127.2%, 144.5%, which is not really a fib, but it is a handy reference point, kind of like the midpoint of the reload zone last week, 70.2. This 144.5 is a kind of a sweet spot of extensions. And then, of course, the 161.8 extension level. Interestingly enough, we're going to talk lots about this down the road. I don't know whether actually these charting applications are actually plotting this 1.618 extension level correctly. But it is an interesting conversation. I'll give you a couple different ways for you to think about this going forward. But ultimately, in mathematics, this very, very important ratio, in essence, from our conversations from last week, this is, I think, probably the absolute cornerstone of all of this is, what is the ratio of one box to the next box if you follow along this Fibonacci sequence? And as you can clearly see, the following box is like almost geometrically bigger. I don't know whether that's the right word or not, but it's not an arithmetic relationship. It's like a geometric relationship. So it's very simply put, the ratio from this box to this box is 1.618. This box to this box, 1.618. This box to this box, 1.618, and this just repeats indefinitely. Same thing in Mother Nature, the way Mother Nature grows. So this is, of course, what's called the golden ratio. And it is the cornerstone of a lot of these mathematical relationships. In fact, to actually derive things like the 1.13 and the 1.272, as I've illustrated down here, they are nothing more than just further mathematical derivatives of this 1.618 or 161.8 golden ratio level. So interestingly enough, the math of retracements was dividing the distance. Where's my definition? I had it written in here. I just want to make sure I get it exactly right for you. Where are you, you silly numbers? Darn. Here we are. So to calculate the retracements, you just take one of the numbers in the series and you divide it by the number following. So, 21 divided by 34. So in essence, this is going to be a fraction of this number, comes out to about 0.618 roughly. 5589, same thing, comes out to 0.6179, right? Very close. And as you go further and further and further out the series, the closer and closer and closer we get to this 0.618. And then if you want to figure out further retracement numbers, well, then it's dividing that number in the series by 2 spots to the right instead of just 1. So that's sort of thinking backwards in the series. Extensions on the exact opposite note are actually dividing going forward in this series. So to calculate the golden ratio, divide one number in the series by the preceding number in the series. So instead of going forwards to calculate a smaller number, we go backwards to calculate a bigger number. So 21 divided by 13 comes out to 1.6153. 34 divided by 21 comes out to 1.619, et cetera, as you go further out the series. So kind of like what I've shown you in this image right here, think of, in essence, this is WD GAN and his basic 45-degree angle, 1 unit of time for 1 unit of price. And of course, this is all of this expressed either coiling up, going forward, if you will, tighter and tighter and tighter into the Fibs sequence, or coiling down and going tighter and tighter in the sequence the other direction. So that's why I wanted to include this image for you, is if you can think about this as either we're coiling up or we're coiling down, but the mathematical ratios all stay exactly the same. And the bottom line here is that this is basically the building blocks of the way the universe works. And we will actually touch on this concept to finish off this conversation today. Think of this sort of geometric progression, both up and down the scale. And I actually think, and it's actually been a relatively recent revelation of mine, a lot of these trading chart applications actually don't calculate this number correctly. So I don't know whether this is a eureka moment or it's Beamish is off on some crazy tangent, but I've got something for you to chew on here at the end of this lecture today to try and speak to this nature of the way the universe likes to geometrically move up and down the scale. And they're all connected. This Fibs sequence and this natural progression. This is, and if anything, if you think about in nature, the way the flowers blossom, it's in essence the expression of this coiling up of energy and the release of the energy. And then unfortunately, regression, the exact opposite. I wanted to include this animated GIF here as a reference, but I knew that if I included this on the screen, it would probably just lull you to sleep while I was talking away. But if you want to see this sort of real-time expression of the Fibonacci sequence and the way that price moves, I thought that was an excellent graphical illustration of how incredibly tightly aligned all of this math is. It's no accident that both price of assets in the marketplace as nothing more than a reflection of our sort of perceived collective perception of value. for a particular asset, and things like the way Mother Nature operates. It has to follow this mathematical sort of, like I said, the code of the matrix. So that's a little bit further sort of introduction to this sort of blueprint of the way the universe works. And I really wanted to drive home this idea that this is, if anything, I think this is a really, it can be for stock prices, commodity prices, networks as they grow. Think of things like POS, cryptocurrencies. It all has to follow this same basic model. So with that said, like I said, last week we spent time going one direction of the Fibonacci sequence. This week we're going to spend time going the other direction of the Fibonacci sequence. As usual, and I think this is handy for you, before the lecture, I went ahead and put together a chart deck that sort of speaks to all the different topics I want to talk about here today, and how you can directly use this information in both the hunting of potential trade ideas framework, and also to obviously profit-taking levels to consider. So I will be sort of cycling back and forth between this chart deck as I'm barking away here today. And also too, I've included a couple older charts, but actually this one I like so much that I actually went and replicated that chart for this conversation. That was this example, because I think it was just such a great working example of that. So, but this one I didn't, but we can work off of this, and it's no big deal. I have other examples of extensions here that in our chart deck that will speak to basically the same conversation. Also to update a little bit with some new things to think about here in this conversation today. So I think probably, just as I did last week, I definitely think it's in your best interest, if you're relatively new to this, that at any given point in time, you just simply write on your chart, what question am I trying to answer with this study I am drawing. That way it kind of helps to make sure that you're heading in the right direction with these. Now, with regard to extensions, it's fairly obvious, as my sort of textbook introductory definition suggests. To draw an appropriate extension study, let's go way back over here. And it just goes to show it doesn't really matter what scale you're using. These concepts are universal. So obviously, if we are seeing a trading range and we are drawing an extension study, then by definition, that means we are thinking that the price is going to leave this particular range, and where is it likely to run into resistance going forward. One of the problems that I have, of course, with a site like TradingView is, intuitively, the best ways, I guess we can just go here, say here to here. If I just throw on the default template, it gives me some nice levels to consider for retracements, but it includes extensions based off the same math. So if my question is, how much of this range is this study likely to take back? Well, then, okay, this study, these numbers are drawn correctly. But because the numbers start off low and they go high, 60% of the move, 70%, 80%, etc., a full 100% of the move, Well, by default, then, if they're drawing their extension levels, they will project those further, right? Because numbers are getting higher, and this is 1.0. But that's not the question that we're trying to answer here if we're drawing an extension study. So this is why, and I said this last week, and I have to reiterate it. I really do not like people to do their retracement study and their extension study off of the same sort of default template that TradingView gives you. Or if you rename this, I think that you're actually setting yourself up for failure. Because as this study illustrates here, it's perfectly fine to ask, if we look at this price action way down here, well, I'm drawing a study to try and figure out how much of this big up move the market's likely to take back. And that's correct. And very normally, ironically enough, way back here, 2013, bet you wish you had all stepped in and bought Brian's favorite fib there at $70 a Bitcoin. And probably none of you would be listening to my funny little rants anymore. You'd be living on your yacht, as they say. But the irony of it all is that's basically your reload zone. So it did everything that it was supposed to do, but I can't draw an extension study. Well, what happens if we break out through the top end of this range? Can I use this study to draw that? No, it says the numbers go in the wrong direction. So as it is out of the box, that's not really setting you up for success. So as you can clearly see, if I want to figure out where the market's likely to go if we break out through this trading range, I'm probably best served just to have this study completely on its own. And these will be some of the levels that we talked about. As I said, straight Fibonacci wise, to sort of start off this conversation, the most important level here, of course, is that 1.618, which is kind of interesting because I actually don't think that it's actually 1.618 of this range. But the only way that TradingView can get you to see that 0.618, which I think is what it is if you actually just look at the size of that box, there's no way that that is 1.618 of that box. It is very clearly obvious that that's about 61.8% of that box. See? Yeah, that looks like about, in fact, we could probably take the little measuring tool here. And my hunch is that's probably about 61.8%. Yeah, look at that. Where's the percent? Oh, I guess that doesn't work. Oh, well, anyway, I was kind of hoping we could just do straight math. But anyway, if anything, this is one of the reasons why these charting applications are actually not doing you any favors. I actually think that this is 61.8. Yeah, you can even see 59.9 off of that level. That's really 61.8% extension. But for the purposes of this conversation here today, we will work with this 1.618 level. Actually, when we talk chaos levels next week, and actually, no, I'll even talk a little bit about this. What's the actual 1.618 extension off of that? Again, thinking about this kind of image where each of the boxes is 1.618 the size of the previous one geometrically, not 0.618. So when we actually think extension levels, we have to be a bit careful here with this. So for the purposes of our initial conversation, we are going to make reference to this 1.618 extension level as the golden ratio. Although, as I said, I'm not totally convinced that this is actually accurate. But what is interesting, though, is if you use this 1.618 and then take the square root of that, that's what actually gives you 1.272. And it's one of the reasons why it's a very popular ratio, because in essence, you can make the argument that the square root of this is nothing more than the midpoint of the breakout level and the 1.618. You can also make the argument that 1.13 is the fourth square, right? The way you write it in math. And remember, I'm not here. My mother was a math major. My father was engineering physics. So I'll leave all the hardcore math to them. But if you can understand the simple math, right, it looks like that over 1.618. So that is to the 4, a square root to the 4th, whatever. That's 1.13. So these numbers are actually mathematically derived from the 1.618 extension level. 1.445 is an interesting one. Not technically a fib level per se, and not directly derived off of the 1.618, but 1.445 is kind of like the conversation that we had last week about the tennis racket. And do we ever get situations where the market sort of sets up a kind of a softball trade location? So there's my fancy tennis racket. Yeah, you can tell I'm quite an artist. So in a weird sort of way, a lot of people do like using the 1.445 as kind of like the midpoint, the sweet spot of this extension study. For the purposes of this conversation, it is a good reference point, but just be aware it's not textbook fib level. It's just a handy reference as a midpoint between 1.272 and 1.618. And hopefully you notice that we do this a lot as technicians, is we end up coming up with levels and then breaking them in half, and then breaking that in half. And you could make the argument the 1.445 is nothing more than breaking the 1.272 and the 1.618 and breaking that in half. And think of this as like the sweet spot of the tennis racket. When I draw my extension studies, I'm really asking, because, back to our original conversation about price analysis, actually, even right back to our introduction to technical analysis, I'm always thinking about the way price moves. And you probably remember this conversation about fractals and the fractal nature of the universe. So this, in trading terms, this inverted maple leaf pattern, fractal, head and shoulders pattern, that's actually a very well-defined structural pattern that actually is nothing more than a trading range. And the breakout of the range, if you remember from I think it was introduction to price analysis itself, when we talked to you about how price moves, right? Remember Nebraska and all that kind of conversation. So if we can remember that price likes to move in ranges, and you remember our conversation about floors and ceilings and the way price moves through these blocks, then hopefully you can appreciate with this kind of image that an inverted head and shoulders or a head and shoulders is nothing more than the definition of a price range. And so by default, I always include that, in essence, just this as a trading range and nothing more than we're just going to replicate that range, one sort of, I'm not going to use standard deviation term, but one range at a time. Thinking again, the market likes to move like a parking garage. It moves from level to level to level. So my default fib extension study includes the 113, which is a pretty important when we get to harmonics in 2 weeks. You'll see that actually a few very important harmonic levels actually have their reversals off of 113. And as we walk through today and talk a little bit about 113s, you'll see that it's often a sort of a trap level. 1.272, you do see quite a few reversals off of 1.272. And again, when we get to the harmonics module, we actually have very specific chart harmonic patterns like the 3 drives that are specifically looking for 1.272 levels. As I said, we'll look at 1.445 as kind of like the sweet spot in between these two ranges. You don't see a lot of direct reference in Fibonacci extensions to 1.445, but I think for new people, it's a good reference level just to keep on thinking like the sweet spot of the bat or the tennis racket. And also too, for people like information risk traders, you'll often find that price will actually even gyrate between 1.272. And then you'll see mysteriously that your double top breakdown will come in right off of the 1.445. That happens a lot. 1.618, obviously the golden ratio. Although I'm going to talk to you in a little while about how maybe this isn't the golden ratio, but that's another conversation for a bit. And then finally, if we are doing nothing more than replicating this range up top, then 200% as that parking garage department store concept. We'll talk lots about that. And actually, I do by default put many levels of the parking garage on my charts. And what I've just noticed over the years, we had a really fun time back in the last decade taking apart Dash Coin, and one of the promoters of Dash Coin was a lovely lady by the name of Amanda. And we used to joke about Amanda's penthouse and how they take price up to Amanda's penthouse. And usually these are classic blow off top levels. So I often like to do, and we'll talk more about this, the department store, naming each of the levels of the parking garage, the department store, whatever you want to call it. And as I said a few minutes ago, thinking about the way price likes to move from level to level, I consider this an important level to have on your price charts, as it is a natural progression target of things like the inverted and regular head and shoulders pattern. So by default, these are the levels that I like to use for my extension studies. Now, suppose we should probably take some time, talk a little bit about what I consider the real golden ratio here. And that actually is the 2.618 level. Why do I say that? Well, if we actually think about this geometric series, hopefully what you'll see is that if this is our starting box, then this now becomes our geometric series as to that ratio of sizes. First range, 1.618 of that size is actually 2.618. Why? Because this is 1.618. This is the 1. So to actually see the 1.618, you have to add 1.618 plus 1 gives you 2.618. So only when you actually put that 2.618 on your extension studies do you actually start to see this image. And I don't think a lot of people in the trading world actually understand this. And I don't think enough people on, every one of these chart kind of platform programs, they're all built by computer programmers, not necessarily traders. So I do see a lot of people making reference to this as 1.618, but I actually don't think that that's actually true. I think actually this is 1.618 of that range, but we'll talk more about that in a bit. So what I've done recently is I used to basically say then the 1.618 off of this, which I think is actually really the 0.618, but that's another conversation. This is going to be a tough one to get through today because I am kind of morally conflicted as to actually how I describe this, because clearly this is not mainstream thinking, and I have a bad habit of doing this, but I hope you can understand the logic of my thinking here, especially later on. I'll show you another application of this concept, and it paints some absolutely insane levels. But anyway, moving on here. What I've found is that 1.618 or 0.618, whatever you want to call it, it is a very good natural target. You often see markets naturally. Thanks, Yanis. You don't like my tennis racket? Oh yeah, I guess it does. Anyway, what I often like to do is I'll actually label this 1.618 to 2.0, thinking about inverted head and shoulders, as I'll actually label this the parking garage, thinking about that sort of the way markets like to stair step their way higher. And then considering how significant I think 2.618 is, I think I can put another parking garage level up there as well, and just keep working your way up. I'm not totally convinced of the validity of 3.618 as it is right now. But, as a student of the market, just like all of you, I'm studying this over time. But in essence, if I was going to start labeling my levels of the parking garage or my levels of the department store, which we'll see in a bit, I think it works something along these lines. Interestingly enough, though, if we do want to continue this geometric series along, what we really have to do is we have to figure out what is 1.618 of 1 to 2.618. This is where it gets crazy, because you have to add whatever that 1.618 is to this 2.618 to get whatever the heck number that is way up there. And we'll talk about this in a little bit more, but actually it paints an absolutely insane number of like 6.8544 or something like that, but we'll talk more about that in a bit. But just to get you going right out of the gate, I think it's in your best interest to track the 1.13, 1.272, 1.445, 1.618, and the 200% range extension levels. And I like to label the 1.618 to 2.0 the parking garage. Kind of similar to how last week we told you about reload zones and how we like to label reload zones. And when we talk more about this down the road, what we're really looking for is this idea of confluence. So if we can get overlapping reload zones with parking garages, with chaos levels, oh goodness, those paint some brilliant trade locations. All right, so that's sort of your basic of how I like to build my very simple extension studies. And I would suggest that you even go in and just label them. You can see I have this label extensions. I also have versions that I put out on like public charts and stuff. And I even did like extension study for when I do lectures. So I do a whole bunch of different studies here. And as you can see, I make a lot of use of the templates. I think it's a good way to not fall into the trap of the default of the way TradingView does these studies. I think it probably actually makes it a little easier. Hopefully you can clearly see with this study, you can hopefully say, what's the answer to the question? I think I put over here. Where did I put that? I thought I put it on this chart, but man, I think it was over here somewhere. Well, oh yeah, here it is. So what is the question I'm trying to answer with this study? Hopefully it's pretty straightforward. And as I said, this is a great way to sort of keep yourself honest and make sure that you're actually drawing the study correctly. Gee whiz, we got to zoom in an awful long way, eh? Holy moly. But it's so ironic, right? The universe is a fractal, and this thing is basically a rise-only market built on the white paper logic. So not a big surprise. All of the same math that worked way back when is the exact same math that works today. It's the same thing. It's just different prices. So, if you write, what's the question I'm trying to answer with this study? And clearly the way I've drawn it, the question that I'm trying to answer is, if we do break out of this range, where are the logical stopping points for this bull run, given very normal expectations? And what a surprise. We topped out up at Manta's penthouse. Anyway, first off out of the gate, let's just make sure that we're drawing our studies correctly. I will say, there is a debate constantly. I don't know whether I want to break this one apart so much, but you can clearly see that this chart here is based off of a linear price chart, and you can see the application of these levels. I think that's pretty straightforward. And on just a very linear basis, thinking that the market is stair-stepping its way up and down, hopefully you can understand the logic of this. We can also, though, study these charts from a logarithmic perspective. And hopefully you see that, wow, the conversation changed quite a bit. That same study now off a logarithmic chart looks very, very different. So what that means is that you have to, if you want to do extension studies, you have to make darn sure that you go in and make that this is clicked so that it's set to actually being drawn off of logarithmic scale. Hopefully you can see quite a bit of difference between regular price chart and the logarithmic. Huge difference. If you do, let's go in. If we do, what's the best way to do this? I think probably, maybe I'll just do a new one here. If you do want to, let's do this one. So if we do want to do linear, so chart is set to linear and study is set to linear. In essence, this is now that same study going off of linear. And you can see on a linear basis, 1.13 definitely got some play there. 200% and even just the regular fib extension zone didn't get any play at all. Didn't quite work its way up to 300%. Actually, this probably would be a good application of our 2.618 level. Yeah, so you can see 2.618, which is, I think, naturally the 1.618 extension of this range. Well, that's where the market had to pause there. So that's interesting. 400%, good old Amanda's penthouse. You can see quite a bit of play here. And then we just went parabolic. And so a lot of people are asking, okay, well, what the hell is the application of this linear study considering what price did? This obviously is where the logarithmic scale study is much more valuable. So if we change that to log, then come back in here. And we can put that back to there. And that to there. And change that to log. Now, based on a log scale, actually we get usable information. So now you can see 200% that parking garage concept, usable information. to try and help us see the top of this particular range. Come on, you. Anyway, you get the idea. Parking garage, had to consolidate. And then we can basically do the same study now off of this range. We can go up the next level. And notice next rally peak right into 1.618. There's our parking garage again. So when we start going parabolic and you get this, basically geometric price increases, because in essence, the network itself is growing. One way for you to see these extension levels a little easier is to change your chart to a log chart. And interestingly enough, you can see how this basically was the pivot off of 127 there. If we go back to the arithmetic, though, just for a minute, well, you'll notice, and this is why I kind of like using this arithmetic now, is what I'm really looking for here is this idea of confluence. So hopefully you can see I drew an extension study off of this particular range. And there is my parking garage, 1.618 all the way up to 200% parking garage. Then you notice I did an extension study off of this range. And lo and behold, 1.618 to 200%, another parking garage, right? This one is right in there. I won't get into it just right at the moment, but this is also an extension level. Remember we said 1.272. Significant extension levels. So more what actually are called potential reversal zones when we get into the harmonics module. So more confluence of levels up here. And if anything, this is what we're really looking for as traders, is we want to see these overlapping extension zones. And then if we can couple them with lower time frame harmonic potential reversal zones at key fib levels, 1.272 for instance, now we're getting multiple messages about potential reversals. PRZ actually stands for potential reversal zone up in and around these areas. So, and then conversely, hopefully you can see this is an extension study off of this down movement. So I have my 113, 127, 1445, 1.618, 2.0. There is my parking garage reference. And interestingly enough, if I do an extension study off of this range, we just recently broke the low, so it has validated it. And again, 1.13, 1.272, 1445, 1.618 to 200% parking garage zones. Hopefully you also noticed from last week's conversation, well, off of this entire range, high to low, this is the reload zone. So now what we're going to be doing quite often is juxtaposing extension zones and reload zones. In this particular case, extensions up into natural price objectives, multiple fib and parking garage reference levels. This is a great example where we're going to use the retracement study. And if we ever get a situation where you have overlapping studies, which produces this confluence concept, hopefully you can see this 786. That, of course, is Brian's favorite fib. This now becomes a very, very high probability reversal zone, potential reversal zone, I suppose we would have to say here, right? Nothing's guaranteed in this business. So, and this is what I'm looking for. I'm looking for these overlapping zones. This to me is super, super valuable trade location information. So at the end of this conversation today, hopefully you can understand the relevance of this image and everything that you see on here. So First things first, let's dig into the basics of how I would suggest you use this information. As I said, and each and every week I include this chart deck. So basically, this was our, start off. I kind of tricked this whole chart out here because I wanted to give you all of everything all sort of thrown together. So you have a whole bunch of different things to look at, and what are we going to be able to do by the end of all of this? Now we're going to just walk through piece by piece by piece and see how all of the pieces fit together. So as we said, I think actually I put it in here. These are a couple older charts from like literally 10, 15 years ago that I did the original lectures, and I actually have replicated this study. This one I didn't replicate, but there is another study that looks very similar that's basically along the same lines. This is in essence everything you need to know out of today's conversation. Here we're going to be using, in this case, a trading range, a breakout of the range, but the range breakout does nothing more than bring us back up into a very respectable shorting trade location. So this could be a case where you play this market to the upside through the inverted head and shoulders, or this could be a case where you would like to get short with the prevailing overall trend, but you don't want to chase and sell down at the bottom end of range. You want the market to work its way back up into acceptable shorting trade location. And how do you think the market's going to do that? Well, it's probably going to stair step its way higher and complete this harmonic and then roll over, which ironically enough, it did. So this is sort of like using this concept in the context of a counter trend rally move, waiting for this to exhaust itself to resume the downtrend. This is a case where we've already established a trend, and the breaking of any market structure, of course, validates new trend signal. And so what we're going to do is we're going to hypothesize, okay, well, what would be some natural harmonic AB equals CDs to take us lower? And then how can we correlate that with this very wide trading range being broken and the understanding that the markets stair step their way higher and lower from trading range to trading range? And where should you expect to see technical bounces as we work our way down into this ultimate destination? Maybe you hunt trend continuation setups, things like bearish bot setups, working our way down into this ultimate objective. Very much like you could have worked this bullish inverted head and shoulders, taking us back up into these bullish objectives, which then actually present a new shorting opportunity in appropriate shorting trade location. One might even argue that once you've actually completed this 200% move and these really big harmonic AB equals CDs, well, now this represents probably a market that's oversold. And I suppose if you're thinking trade location, now you want to go look at your indicators, signs of divergence, indicators actually saying you're oversold, and looking for structure to actually maybe frame some sort of dead cat bounce trade coming out of this big technical objective getting hit to the downside. So there's two different ways that you can use extensions, but what I would definitely suggest to you is you really want to think of this confluence idea. If you are, I suppose, a price risk trader, ideally you want to have three unrelated reasons to justify location. Maybe it's something like an inverted head and shoulders takes us back up into a reload short zone, which takes us back up into horizontal support and resistance, which takes us back up into institutional fingerprints, which takes us back up into maybe trend line resistance, et cetera, et cetera. So first things first, want to make sure that you understand exactly what it is that you're drawing. And if you need to write on your price charts, what question does this study specifically try to answer? That's not a bad way to keep you honest. I think it's a good idea to create templates, and I do not think it's a good idea to work with TradingView's default template for Fibs because it's actually setting you up for failure. We talked a little bit about log versus linear. I think both methodologies are accurate, and I'll even show you a couple examples of really, really good price targets that were established both by doing log scale and linear scale studies. Just understand that when you're using a log scale chart, you have to be extra careful about what it is that you're actually trading. If you're thinking about an asset and it growing in value and it growing in size, something like a network, then it's appropriate to use log. And really, most stock indexes, stocks are nothing more than earnings engines. So a proportionate increase in earnings has to be reflected proportionately through the stock price. Log is actually the good way to measure the growth in the market. The only problem is if you're a leverage trader or a futures trader, every penny movement in the market is exactly equal. Usually the multiplier is like $5, $10, something like that. And it doesn't make a difference. So for those people, it's critical they use linear charts because a dollar is a dollar is a dollar. And while I might argue that from an analysis perspective, understanding growth, probably better to default to a log scale for those day traders who are looking for very specific levels, and even more so for those people that are calculating risk-reward ratios. Well, obviously, every penny is exactly the same. So you're best to use a linear scale chart. So specifically, let's walk through the different levels and how I think you should interpret them. As I said, 113 is an interesting fib in that it's kind of like the in-between of the 1.618 and the 1.272, and it's in between the 1.272 and the 1.0. Did I say that right? No. 1.272 is the in-between between 1 and 1.618. 1.13 is the in-between between 1 and 1.272. Well, that's a mouthful. What you will see repeatedly is quite often false breakouts in the market often are 113 tags. So if I'm day trading futures contracts, for instance, and I'm thinking that maybe we might get a breakout to the upside, I'm going to be watching for the 113 head fake up in here like a hawk. Quite often markets will move. You might even consider this like a stop run. A whole bunch of stop loss orders are just sitting below this level. This market opened up, just went screaming down. As soon as it tripped up through here, price probably went quite chaotic as all those stop loss orders became market sell orders. And believe it or not, there are traders out there in the world that just sit and work a stink bid at 113, expecting this level to get run and expecting a little bit of chaos through that, and that often pushes price into that 113. So here you can see great example of it to the bear side where that was a trap, market turned around, and you can see they did it here exact opposite. Interesting that the stops actually would have been run this candle, but this candle we actually opened up above it, ran into a world of selling, and basically puked out the other side. So we will talk about this in length in our harmonics module. Let's see if I can just show you a quick cheat sheet of this. And I did talk to my harmonican buddy who I've been working with now for well over a decade, and he did say he would love to chat with me. We might do a little side video just on Steven and how he trades harmonics as a nice little sort of addition to this. But hopefully you can see when we do get to the harmonics modules in 2 weeks, you can see that one of the patterns that I actually like to hunt for on an active basis is the shark pattern. And you can see, in essence, it is basically a major test of the previous low, but it can go to that 113 level, that sort of final FU move. And there are quite a few harmonicans that trade based off of basically, when we were doing horizontal support and resistance in the Nebraska FU setup, right? Got to keep my job as a prop trader, so I have to force myself to come in and buy on a break of those lows. So if you have that 113 level on your studies, you can often see that false breakout really easily. So that's the number one reason why I think you should include that 113 study on your on sort of your fib extension default template. Is number one, it's often a fantastic trap level. And if you are the Nebraska type and I have to force myself to come in and buy against lows and sell against highs, well, this is a really good reference point for you. Maybe in your trading plan, you say, look, I actually wait for the 113. And if I see any kind of signs of reversal off of that, I just go with it. Totally possible. Nothing wrong with that at all. So that's level number one that I want you to be thinking about. Level number two, and actually more reversals do happen off of things like 127.2 tags. But this is the next level that I really want you to be thinking about. This happens to just be a very simple 1.272 tag followed by a double top and then a breakdown. Nothing really overly thick about this. What I will say is when we get into the harmonics module, as I had said earlier, and keep in mind all these topics are sort of dovetailed together. So that's why I said this module, all of these modules will be interlinking. Sometimes you can actually have like the 3 drives pattern illustrates here. If we can get a succession of 2 1.27 to that should be 1.272 extensions in a row, this is actually a very popular, very common harmonic pattern called the 3 drives. I suppose we could probably find others around here. And always whenever I try and find this stuff on the fly, it never works, but let's just see. There we go. So in fact, actually I have a 1.272. There it is there. So this might be an example of 1 drive, 2nd drive. This is your 3 drives pattern. And actually you can even see they have a tool on here on TradingView called 3 drives. I haven't used this in quite a while though, so this might be wrong. But something along these lines. I don't know if I did that right. Nope, one too early. Let's go something like that. There we go. There to there, there to there, there to there, there to there, and there to there. Something along those lines. Hopefully you get that idea. Yeah. So 1.272, 1.272, double top, sell signal. Yeah. Hopefully you get the idea. Point here is that 1.272, we do see quite a few reversals off of the 1.272. And I suppose, this is the difference between the price risk trader and the information risk trader. Both are perfectly valid. It just really all depends on you as an individual. What do we do to get you to be set up for success and sort of mentally you can handle this? Maybe you hit the 1.272 level because you just that extension level so much, or maybe you just wait for some sort of 3-bar fractal. Maybe that's a double top, whatever. But maybe you need a little bit more information to frame the trade as we come into that level. And as you can see, as we came into this level, we didn't even really go beyond this at all, which leads me to believe it's quite a bit more of a valid level than this one. But the three drives pattern thinking, that does make sense. And then maybe when we get up into this 127, you see this violent pullback right off of the highs. Maybe you do something crazy like draw a reload zone off of this range, and you get in there and you start hunting short setups off of this reload zone fail. You know how much that Beamish guy loves his 78.6s. So the point being that this is an excellent level to consider taking trades. And then also too, and I don't think, well, actually maybe I have it on here. I think we even had recently, yeah, that's what this was, right? So this 1.272, I trade a particular trade setup that trades harmonic extension levels. And one of the alt AB equals CD levels is this 1.272. So again, going back to our harmonics cheat sheet, there you see the 1.27. There should be a 2 in there. But anyway, you can see how that is a relevant alt ABCD level. And you could even make the argument, even with a normal symmetrical AB equals CD, if it's tilted up enough, you might even see a 1.272 from the B to D. So 1.272, as you can see, comes in here, does play a bit here. Even on things like butterfly patterns, you'll see that the 1.272 comes in there. So these levels, we will repeatedly see alt A, B, C, D. You can see the X to D could be as deep as 1.272. So we definitely have to have this as part of our repertoire. We need to understand that 1.272s, the market does quite often like to reverse off of that level. All right, let's see how we're doing here. So we talked a little bit about 113s, and those are potential trap levels. We now talked about 1.272 and the propensity to actually see the market reverse off of 1.272s. We'll skip over the sweet spot for the time being. And of course, 1.618. Yes, on these extension studies, it does say 1.618. I still don't know whether I really buy into this. I'm thinking more like this is the 0.618 of the previous range, but I'm conflicted over this, to say the least. But here's a good example moving right along. This is actually how I would typically draw things like extension studies, and this actually is the image right here. So I actually think that if I was ever going to teach a course on this stuff, this is actually, I pulled this chart up from like 2014, and it basically describes everything that I'm trying to impart on people. Hopefully you can see the price actually broke these lows. So technically this is a downtrend. And the problem is, of course, we can't really think about shorting down here. If we pulled up our indicators, they're probably all oversold. And, if we were drawing our regular good old Fibonacci retracement study, where is the reload short zone? Well, it's actually way up here. Like so. And then, again, referring back to our conversation from last week, if we want to actually see where did the institutions actually stop bull rallies and say, no, sorry, stop going up, you go down, you're a bear, go down. Well, that's what these points are. And notice that they're right up in that reload zone. Not an accident. So we come all the way down here, paint somewhat articulate inverted head and shoulders. Where there are ways for us to validate that this is an inverted head and shoulders. We'll get to that when we start studying momentum divergence and volume patterns. But for our conversation here today, we can just simply postulate that this is an inverted head and shoulders. And so then by definition, if we think about the parking garage and the way markets move, in essence, this is a trading range. And if we do accept back above this level, then we're probably more likely than not just going to replicate that range higher. Now, if you're going to draw these inverted head and shoulders, we have to think of number one, maybe this is nothing more than a harmonic, A to B, C to D. And you'll notice that the default target that we have on inverted or even head and shoulders tops for that matter is that this isn't going to replicate this range completely, that this is nothing more than an A to B, C to D harmonic, which means that our default target should be this 1.618, which is actually 0.618, right? Right. And if anything, this makes sense too. If this is 100% of the range, and this is a duplication of 100% of the range, then there's no way that could be 1.618. That is 61.8% of this range. So the simple fact here, though, this 1.618 is very important. As you can see, if we just simply drew an A to B, C to D, well, that is technically a PRZ, or potential reversal zone. And you can see it did get quite a bit of play in here. But by default, you should expect that an inverted head and shoulders wants to hit its 200% objective. That really shouldn't be a surprise whatsoever. What should surprise us here, though, is who would be willing to step in and buy up here? We already know from a reload zone perspective that this actually is the level that institutions want to short. What's interesting about this, we'll talk more about signs that the market is exhausted later on, but things like the relative strength index actually getting into overbought camp. Well, I don't know whether I really want to buy when an asset is overbought. Of course, I have indicators. We'll talk lots about this down the road. But indicators specifically built to tell me when the market's overbought, and Willie is very stupid here. And you also notice, for anybody who doesn't understand this stuff already, but we'll get to this when we get into indicators, but this is a massive divergence coming into this head and shoulders objective. So even the market itself is actually telling us internal messages that, yeah, I'm done. So the point being that actually this isn't a bad place, about maybe 100 and a short. And of course, all of you are gap theory aficionados right now. So that means you all know what this pattern, that bar there, and that bar there, and that bar, whoop, let's do another one, that bar there, let's go up. And you could even make the argument there's even a smaller, but that's basically an island top. That's a wicked reversal. You could make the argument there was a little island top right up here. Although candlestick people would say maybe that window has been closed with this rally, but I would still consider that open. Anyway, outright candle island top up here, classic reversal signal. The only problem is how the heck do you get short? But you can clearly see that was definitely a fail level. So the point being here, and this is what I wanted to point out with this, and this is a good example where maybe you were thinking short and you wanted to get short, but I can't short down here. Let the inverted head and shoulders play itself out. Maybe you take that trade. Maybe you bought some off of this consolidation and you spoon feed. Maybe you sell like half the position at 1.618. Maybe put the other half of the position up for sale at 2. Nothing wrong with that. Later on we'll talk about stop management and how you would manage those stops. But I think on this failure here, you'd probably be stopped out of a running position anyway. But the point here is actually came up nicely into a short trade location, and it was basically a confluence of I'm a bullish study and I'm projecting up into here. I'm a bear, but I've been absolutely wiped out. So if I'm going to start thinking about shorting again, where should I be concentrating my efforts? Those people that are 1.618 fans and thinking price risk trade, well, maybe you got your signal to get short off of this move right into here, but you can clearly see that information risk trade, excuse me, that price risk trade. There just wasn't enough information here that this thing was exhausted and it was done. Our indicators here showed no signs of divergence at this point whatsoever, no signs of failure. So that was a little bit early. And the price risk traders were told very quickly, nope, sorry, you're wrong. We're heading higher. All right. So hopefully we had a good conversation there about 1.618. Very, very important level. Called the golden ratio, but as you can see, I've made a second reference to this. The way that I actually look at this 1.618 from this range extension level is I actually like to think of the 1.618 as the bottom of the parking garage. So examples of parking garage studies here. Let's see, do I want to use this one? Well, I don't want to quite get into him just yet. Let's maybe work off of here. You can think of the parking garage. You can also think of actually, that Bitcoin chart's perfect. This is the one that I really wanted to talk about. So this, I think, is an excellent application of this parking garage kind of concept. And if you are moving higher, right, just understand that once we get up to 200% of whatever this old range is, this thing's living on borrowed time. Oh, where'd the YouTube page go? Hope it didn't crash. I guess my co-show host here would tell me if we're in trouble. I think we're over here. Let's see. What happens if I go over here? Boom. Hey, there we are. Yay. Maybe Yanis. Yeah, that's not bad. Hey, yeah, hey, look at that. I already made a positive difference in Yanis's life. 1.13. That's cool, man. Gonna keep an eye on that. There's a good example of one over here on Bitcoin. You can see how we tried to break out higher. We ran up into that 1.13 and just smacked right off it. Okay, so let's stay on the parking garage conversation here. So I really like the idea of drawing old studies. So this is a study going backwards, looking at this price range and what would be the extension levels off of this range's breakout. At the same time, too, though, I've also drawn an extension level off of this range. So I've got like two battling ranges here. And again, if we get up into parking garage levels, and the proof of the pudding's in the eating, you can clearly see that we got up into this 1.618 to 200% zone, and the market just ran out of steam. And the worst part about all of this, of course, is when is the public most bullish? They just don't understand that if you had bought Bitcoin above $100,000, $110,000, you were kind of walking into a trap here. So it's a little bit sad, but it is the nature of the beast. So I think this is a really good application of that parking garage kind of concept. But if we get absolute runaway markets, price doesn't have to stop in the parking garage. So this was an example from that last bull run. And I think it's important that we always put these breakouts into context. Hopefully everybody can see here that this breakout through this range, kind of like what we were talking about with gap theory and how you wanted to see the breakout gap on heavy volume. Well, same thing here. By this volume bar clearly eclipsing all previous volume bars, this market was basically saying, hey, I want to explore higher. Now you can clearly see we got up into natural 200% parking garage levels. There was a little bit of play here, but no structural breakdown here at all. And then we promptly went up to 300%. And then we promptly went up to 400%. So in essence, this is one range, two ranges, three ranges, four ranges. Very rarely do I ever see the markets actually blowing past this 400% extension level. And that's why I've affectionately named it Amanda's Penthouse, because you can imagine anybody who got in on the ground floor of this dash, you know, even through here. Hopefully you can see a nice little W here. Well, that was $300 and this thing topped out at like $1,500. That was a big move. So great illustration of using this concept of the stair-stepping the way in the market higher and that Amanda's Penthouse kind of conversation. What's interesting is, of course, you can do this both going up and going down. So here, hopefully you can appreciate that sure looks like a head and shoulders top. And of course, if it is a head and shoulders top, that means we should expect a measured move. That's what this kind of movement is called. And if you probably never, you know, it's funny how there's just funny little expressions in technical analysis in the market that people drop. And, you know, just totally random, and the concept like a measured move. A lot of people have no clue what does measured move mean? Well, this is an example of a measured move where we are clearly defined a trading range. We have lost the trading range, so odds are we're going to replicate that range to the downside. And you can see they did this in a heartbeat, just boom, straight down to the bottom of the parking garage. In this case, a bearish parking garage. And notice you can see the back and forth, quite a bit of fight. Then we lost 200%. So think range extension again. And you notice that we bounced off at 2.618, came right back, had to kiss this 200% from the other side, and then went puking right out. In fact, we quite literally went from 200% all the way down to 3.618 here. Then more back and forth, battle, battle, battle. Then we had to go all the way down to Amanda's Penthouse. And of course, in this case, Amanda's Dungeon. And then you notice, oh, politely, look at that cute little W that just came in right at the bottom end of the range. And yeah, I suppose, you know, for the information risk people, wow, there is a beautiful analogy of concepts learned last week in the venture cap reload zone right off of, actually here, why don't we even go here, right off of the bottom of Amanda's Dungeon. Ooh, dun, dun, dun. Beautiful level. Absolutely textbook. So really good example of a very simple, I think I would just call this a market structure. Think of the maple leaf. The way the market stair steps its way lower, just simply replicating those trading ranges to the downside. And, you know, you can think of parking garage. Another way that I used to describe this is to think of this as the department store. So here we are down at the basement, right? This is, you know, Christmas decorations, I suppose food, you know, a lot of the department stores now have big grocery stores in them. Then the next level of the department store will be things like household goods. Then the next level would be things like leisure wear, women's lingerie, all that kind of fun talk. And then I guess maybe down in the toy store. In fact, I remember when I was growing up, Simpson Sears. Anybody remember that? That's from a million years ago. And they even had their toy department and their women's lingerie department on the same floor. And I think that's probably because moms would take their kids to the department store. And while the kids were looking at all the toys they wanted for Christmas, mom would be in the lingerie department, I suppose. I don't know. Anyway. So, point of the matter here is this is a really fun sort of graphical way for you to see us moving our way through the parking garage or the department store. And we can do the exact same going the other way. This was these fun little space stocks that were rallying recently because some guy wanted to become the richest man in the world, all that kind of fun talk, regardless. Hopefully you can see the trading range that was established. We broke out of the range. And if you had drawn your very simple parking garage concept, you can quite literally see how this worked its way right up into Amanda's penthouse and then promptly crapped out right back down. In fact, I hate to say it, but you could probably actually draw fib extension levels now off of this range, and wherever that 1.618 is, that's probably where we're heading. Oh boy. Let's hope we don't, geez, all the way down to $1. You know, the sad thing is it wouldn't surprise me because I've never understood why this company even exists. But anyway, that's here nor there. Interesting, 1.13, probably 1.272 will represent pretty good support in here. As we come back and do things like reload zone test, right? We'll probably go like that and go like that. And now the good part about with what you've learned here last week, what you're learning here this week is this whole idea of confluence. And of course, to go, we did trend lines. So now you can see, geez, if we get a nice dip down into this 88.6 in this gap. Of course, we did a module on gaps recently. So now you should understand that. Now you can actually say, you know what? We get down to this 1.272 and this trend line, this 88.6, and fill in this gap and back against this original market structure bottom. And I could actually think about maybe taking a shot on this thing. Not bad. Also, too, we could do fun. I haven't done it in earnest yet. This will be the module on harmonics. But hopefully you can understand, very much like we saw with that gold market. Where was that gold market? That was this one. I think it was this one. So the A to B, C to D, right? We can even put these levels as references on the chart, A to B, and then C to D. Boom, 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 boom. 1.618. Well, no reason why we can't do that on this chart while we're at it. So A to B, C to D. Interesting. This ABCD is going to take us almost exactly against that 88.6. And oh, there's that 1.272. Right? To see this ABCD study, we'll do something like that. And then we'll do something like that. And we may not necessarily have a trade that sets up in here. But there's no reason why you can't just load on like the AB equals CD harmonic, PRZs, etc. And that to me, $2.88, that looks like a very reasonable trade location. And hopefully what you see here is when I see 88.6, see the original market structure, I see the gap level, I see the AB equals CD, PRZ, I see 1.272 extension. I'm starting to see a confluence. All right, not a bad idea. Maybe just right on your box. Wow, confluence. Talk about trade location. So Hopefully you're getting the hang of extensions. It's pretty straightforward stuff, both as ways to understand the price move up, and then also too to understand how price is moving down. And now it sure looks to me like maybe we even make this even smaller. I think we can, get very serious about stepping in on this name at around $2.80 some odd cents, $2.90 down in that area. Cool. All right. Didn't really expect that to come out of today's conversation. I don't know whether I have any interest in buying Richard Branson's stock, but hey, if you are interested, there you go. Caveat emptor, as they say. Okay, let's see how we're doing on our agenda. So we've talked a little bit about the 1.618 and both the reference of it being actually a 0.618 breakout of the previous range, which in itself is a very important fib number. In fact, there's a trader that I used to trade with a million years ago that this is all he did. And so as a result, I called it his name when I was teaching this course, Mountain Man. Good old Brandon Rigo. But also, hopefully also too, you can understand the significance of 1.618 with regard to this parking garage concept. And what I have noticed, and I do understand it from the 2.618 perspective, because I do believe 2.618 actually is the 1.618 natural Fibonacci extension level. So I hope you can appreciate that's a pretty important level. I will put 2.618. We'll also talk lots about this when we get to chaos theory next week. But I'll put that on my charts as well. All right. So hopefully we talked a little bit about the department store. 2.618s and 3.0s are like the tour department. And then finally, if you can get it, blow off top, 3.618. I'm not totally on board with this, but since it is another 0.618 extension level, I do understand a lot of people respect and watch this. Half of our job as traders is just to simply see all the other levels that other traders are seeing. So here often is a good example where maybe we don't top out exactly at 3.618. I would expect Amanda to be traded to, and in this case you can see rather nicely, and it turns out that was the end of the move. Could you have framed some sort of behavior up here? I'm not going to say it would be easy, but my hunch is there probably was some sort of top if we went down to I don't know, maybe like a 30-minute chart. Well, even there off of the 4-hour, you can see off of the 3.618. All of you should look at that after our candlestick conversation and say, well, that's an inside bar. That's a Barami. That's a bar fractal. Okay, well, I can understand that would be a short from that level. The only problem is the market didn't give you the opportunity. It just gapped lower. See you later. I'm out of here. Could we have found maybe even a lower time frame setup up there? It wouldn't surprise me. Where is that? Oh, yeah, there you go. So you can see top here, right off of the 3.618 level, you can actually see a breakdown. But again, they just didn't give us any opportunity to get in on the darn trade, eh? You probably have to be trading after hours to somehow even get that trade. Let's see if it showed it in extended hours. Ah, there you go. So in extended hours, you could have gotten the trade off. Yeah. So everybody's going to have to open up their after hours brokerage house now. What's interesting, and I suppose maybe we'll jump into this in 2 weeks' time when we do harmonics. So I wonder actually if this was a harmonic. 53. Yeah, well, it's kind of batty. Anyway, but my resident harmonican, Steven, actually, maybe I'll show that to him, see whether that would have cut his jib. Yeah, is that the right word? I don't know. Interested in, let's say. But you can clearly see the failure here through that 3.618 down the road. So, price risk trader, fine. I'm just going to hit Amanda up there because I love her so much. Beautiful railroad tracks right off of that level. And then also, too, if you think about things like reload zones, that's that 88.6 reference there. But, once we get up into these higher time frame levels, Amanda's penthouse, I think it's an excellent idea for you to not chase and not get all freaked out up here, but then just let the market break. That probably confirms things like breaking of previous structure, maybe creates divergences, maybe your indicators are ridiculously oversold or overbought at this point. And notice, let the market dump. All those momentum indicators now go from potential to confirm, and then you get a nice polite counter trend rally into reload short zones, and you get an absolute gift. Can you imagine if you were sitting there, hey, I shorted this thing at that Beamish's favorite fib. I don't know. It just felt like it was a good thing to do. Hey, caramba. Drinks are on you, my friend. Whoa. All right. Hope you got some value out of that. So showed you an example of use the parking garage concept, department store to work my way down into Amanda's penthouse, and showed you an example I would use it going up into Amanda's penthouse. Two perfectly good examples. I'll probably just leave it on the daily chart, eh? Where is that? Is that right here? Yeah, there you go. And keep in mind, everybody, that you can access this and just make a copy of it and save this for your files. It's a great reference piece. Okay, so we've now talked about 2.618s, toy department, 3.618s, and 4.0. Think Amanda's penthouse. I wonder where Amanda is in this world right now.